Hello, good morning, everyone, and welcome to the latest instalment of Nova Global's Pulse webinar series. Delighted to see so many of you join us today. We're really excited and enthused to be joined by one of our selected discretionary fund managers, Waverton Investment Management. My name is Alex Kay, Head of Investment Proposition here at Nova Global, and I'm joined by John Bellamy, Head of Advisor Solutions, and Luke Hyde-Smith, Co-Head of Multi-Asset Strategies at Waverton Investment Management. I'll shortly be passing over to the Waverton team, who will introduce themselves and proceed to take you through the main body of the presentation, which we anticipate to take approximately 25 to 30 minutes, after which we'll look to run through any questions or queries that are raised throughout the presentation. If you do have any questions during the slides, there is a questions tab towards the bottom of the page. If you enter any questions in the box and submit them, we'll look to address those in a short Q&A session at the end of the presentation. The theme of this month is focusing on the topic of what to do with the 40%, a new regime of higher ongoing inflation and a perceived inability of traditional investment approaches to adequately diversify portfolios has brought back into question what other options and asset classes can help to enhance and diversify a portfolio. Waverton will take you through their philosophies and approaches, explaining how they address this fundamental question. So without further ado, I now pass over to John and Luke, who will now take you through the presentation, which we hope you'll all find both interesting and insightful. Over to you, gents.
Morning. Thank you very much, Alex, and thank you everyone for joining us. So I'm just going to canter through a couple of slides really to give you a bit of an introduction to Waverton and the way we invest money, and then Luke will go through the meat of the presentation. So Waverton, we were established in 1986, previously as J.O. Hambro Investment Management, which might be a name that's a bit more familiar to some of you. We've currently got 8.7 billion assets under management. That was at the end of the year. Clearly, there's been some volatility in that since the start of the year, but I very much hope we're careering toward 9 and then 10 billion as we are in a strong growth phase at the moment. We are independent and we have significant ownership from staff. About 85% or so of our employees own shares, and everybody who has shares in the business has bought them, and nobody's been given them. We're investment led. I'm sure that probably doesn't sound that surprising to you, but I'll touch on that again a little bit later. But client driven as well, trying to deliver everything we can for our clients. And by that, I mean individuals as well as advisors themselves. And responsible stewardship is at the heart of our investment process. So there are four key pillars to the business. The private client business is the largest, which is about 5.5 billion of assets. We've got a funds business that does some single equity strategies and some bond strategies and some multi-asset funds. A growing and successful and award-winning charity business of about 1.2 billion. But being biased, I would say that the jewel in the crown is the Advisor Solutions, and that's the team that I run. And we sell our wares, we sell the products of our investment team through the advisor community, and it is by far and away the fastest growing part of the business at the moment. At the heart of that, at the heart of the four teams and delivering the investment solutions for all of them is the investment team. So when I said earlier that we're investment led, hopefully this slide can show you exactly what I mean by that. There are 30 individuals on here, and the vast majority of them have no client-facing responsibilities at all. They are involved with being portfolio managers for specific funds or investment analysts on sectors, whether that be geographic sectors or whether it's fixed income or whether it's, as in Luke's world, the multi-asset team. Bill Dinning is our Chief Investment Officer. He's previously been at Keynes Capital. He was also the chair of the British Coal Investment Committee, and he set this team up very much on an institutional basis, and that really is our aim, is to deliver institutional qualities to private clients via platforms. As an example of that, our head of equities, Jenny Fisher, was previously at head of US at Schroders before here. We've got Stefan Reinwald, who lived and worked in Japan for 15 years at one of their largest brokers out there. And there is high quality experience and knowledge across the piece. And Luke himself, who's looks belie the experience, has got 17 years of experience and is the co-head of our multi-asset team. So moving on, just very quickly, our investment approach. We are objective-based investors. And as such, all of our portfolios target clear objectives, which are real returns throughout the cycle, delivered with the lowest level of risk that we can. And we do that through the medium of directly invested global multi-asset portfolios. And as Luke will touch on, that multi-asset part is probably of more importance now than it ever has been, given that the equities are trading as high as they have been, certainly on a PE ratio since the big sell-off. And bonds, if the start place for equities is bad, the start place for bonds is even worse, given the direction of travel for interest rates. We are highly active at all levels: asset allocation, stock, fund selection, but also at hedging. We hedge our portfolios at all times. The portfolios, because of the direct investment, also deliver very high ESG scores, which you need to know is a result of the way we invest. It's not a target of the way we invest. The core models are here in front of you. They go from conservative up to equity, from defense through to growth. They've been running for 10 years now. The equity and the conservatives are relatively new additions. You can see the CPI targets on the middle column. They go from CPI plus 4.5 for equity down to CPI plus 1.5 for conservative. And we're on DT, de facto, and other risk tools. And then finally, from me, or nearly finally from me, from a portfolio construction point of view, we deliver these portfolios through 4 asset class funds. We have a fixed income fund, an equity fund, alternative and real assets. And each of these funds will be blended to meet the requirements of specific portfolios. So you can see on the right-hand side, our current balanced portfolio has 61% in the equity fund, just under 14 in fixed income, 8.7 in absolute return, and 14% in real assets with a small cash weighting. And we can touch on that. It's a bit strange, but we can, if there are any questions on that, I can touch on why we construct our portfolios that way towards the end of the session. We're available on a vast range of platforms. I think we're up to about 21 at the moment, but obviously the most important one is Novia Global. And I should have mentioned those funds that we build our portfolios through are offshore funds, so are very good within the space. So with that, I will now pass over to Luke to go through the meat of the presentation with you.
Good morning all, and thanks very much, John and Alex, for coordinating this morning. So what we're going to touch on, as the presentation suggests, is this 40% challenge that investors face with regards that traditional asset allocation, 60-40, 60 in equities, 40% in bonds. And what does one allocate to in that 40%, given there are some big structural challenges? But just to frame that, we've got a couple of slides on where we've come from and some of the challenges out there currently. So on this first slide, we show the direction of travel over the last 50 years in the top chart of the US 10-year government bond yield. And you can see back in the late 70s there that the 10-year yield peaked at just over 15% and has really dropped and fallen all the way down to near enough or close to zero back in the end of last year. And what this has led to is a very strong environment for traditional asset classes. And that is what's shown on the bottom chart there, which is the returns of various government bond markets and the equity market in the dark brown line. And I think there's a couple of things to pull out there. On the first chart, what we're seeing now is a recovery or yields beginning to pick up and price back to the may go towards the long-term average here. The shaded blue there is just a forecast indicating what would happen if yields rose back to the long-term average of the last 50 years. And you can see that would be well over 5%. So a material change in interest rates if they went back to long-term averages. And I think what's really important to note is this falling yield environment has been very strong. Equities have been good, which is a dark brown, but the government bond market, and in particular UK gilts, over the 35 plus years that we've shown there, have been the strongest performing asset class, namely because yields have fallen and bond prices rise in that environment. And actually lending money to the UK government over that time period has earned you something like an 8% compound return on a 7% vol. So not only have you had a return which is greater than the equity market here, but you've done it on much less risk. And I think that is a little bit underappreciated by investors with regards not only the returns, but the risk profile. So if we just skip on to the next and sort of frame where we are currently, well, clearly this top chart shows you here, we are into a regime which we have not witnessed since February 82, which is US CPI, i.e. core inflation rate in the US, has risen above the rate that it was last at 40 years ago. And this is a material change to the outlook. Now, clearly there's a big debate as to how sustainable this is. Is this transitory? How high is it going to go? But we would just note we are potentially into a different regime here. And again, all we've shown in the shaded blue bit at the far right of the top chart there is what would happen to inflation should it just go back to the long-term trend. So we're not making a forecast there, but we are saying inflation may fall back to the long-term trend, but quite clearly there are also some big pressures out there, be it through the commodity prices, be it through the cost of food, etc., which may keep inflation higher than it has been for some time. And the fact that it has broken out arguably means that we're into a different regime that we've witnessed for the last 40 years. And on the bottom right is a financial condition index, which just shows the sort of tightness out there versus historical normals for general financial conditions. This is a combination of inflation, interest rate, credit spreads, etc. And a lower number indicates financial conditions are tightening, and a higher number means they're looser. And broadly speaking, apart from the COVID period of Q1 2020, we have been in an environment of reasonably loose financial conditions really since the GFC. And I think it's also worth noting that for the first time in the last 10, 15 years, conditions are tightening, and that has potential big ramifications for returns, particularly in interest rate sensitive assets such as fixed income. So what are we doing in that environment at Waverton? If we just flick on to the next slide. Well, this frames the relationship between equities and bonds at various rates of inflation. What we've shown here is the rolling 3-month correlation between the US Treasury market and the S&P 500 versus levels of core inflation. And if you look on the sort of bottom x-axis there, you can see the various levels of core inflation, and on the left-hand side, the correlation between treasuries and equities. And I think there are two distinct things to pull out here. Number one, this is data going back to 1960, by the way. So, it's well over 60 years worth of data. And there are 2 points to pull out. Number one, the majority of the green dots are on the left-hand side. So we have been in a disinflationary environment. Inflation broadly has been below 2.5. And the other key point, which we've highlighted on this chart, is that at the rate of 2.5, the correlation between equities and bonds tends to turn positive. We've actually been using this chart for the last 12 months or so, and that red dot, which indicates the current reading of the correlation in US inflation, shows that 3-year inflation in the US has risen to 2.5. And it's interesting to note, what have we seen over the course of Q1 so far? Well, we've seen a positive correlation between equities and bonds, i.e. they've both fallen. And that could be due to a higher inflationary regime. So us as investors, portfolio managers, makes us think very, very carefully about what sort of assets that we want to introduce into the 40% part of portfolios that not only enhance returns, but bring in additional diversification. And this is an absolutely key chart to the market outlook currently, because where inflation moves to and resides will really impact the pricing, not only equities, but clearly fixed income as well. We just fast forward one, just talks a little bit how we frame the alternative allocation at Waverton. We split our alternatives into two distinct camps, one being the absolute return. So these are strategies across the three areas that we highlight there of either specialist fixed income, structured opportunities, or absolute return strategies that we can combine to deliver a positive return at an aggregate level in a variety of market environments. This is a strategy which seeks to sort of do the diversification properties that fixed income has previously delivered. We're not saying don't own any fixed income, but what we are saying is that it's likely in a higher inflationary regime, you lose some of that diversification benefit, and having an absolute return fund seeking to deliver a positive return in any market environment is an attractive allocation to bring into portfolios, particularly at the lower risk end of things. And conversely to that, or the other side of our alternatives allocation, is what we term real assets. So these are long only, return seeking alternative asset classes across these 5 core real asset classes, and we can go into a little, we'll come on to describe them in a little bit more detail, but we think these assets have got a really important role to play in investment portfolios currently. You know, there's income, there's attractive return profile, there's contracted cash flows which have limited economic sensitivity, and in essence what we're trying to capture there, if you think back to that 10-year UK government or the UK gilt performance, 8% compound on 6-7% vol, what we're trying to find in the real asset space is the sort of return aspect that one has achieved historically through fixed income, but we are expressing that and delivering that through a variety of real asset classes, which we think look very, very attractive in this current market environment. So we just go on one. Just defining the real assets universe in a bit more detail, because this can mean a few things to different people. We have left it purposely broad. So we incorporate property, infrastructure, asset finance, commodities, and specialist lending across our real asset universe. And you know, they have some common characteristics, namely, they will tend to perform better in periods of positive economic growth. They often have very attractive, as I said, contracted, often inflation-linked cash flow streams, which come through in an attractive income. And we think actually there's a bit of a relative valuation opportunity here, particularly versus some parts of that fixed income landscape, which look very, very unattractively priced. So we can come on to describe these in a bit more detail, but it's important to note we've left it broad, and we think there are some great opportunities across the whole real asset universe. And to come on to show that in a bit more detail, the next slide, you don't have to take our word for it. This is data taken from the capital market work that BlackRock do and make freely available on their website. And they just forecast the long-term returns for a variety of asset classes. And we've taken the 15-year nominal returns for both fixed income, real assets, and equities, and plotted them here on this chart. And you can see where real assets fit. Right, there's in general a pretty material pickup in return for a similar level of risk versus fixed income, and also some diversification versus equity returns. The other thing that's important to note is that within the real asset universe, you've got very sort of fixed income-esque return profiles, such as social infrastructure, long-dated cash flows, very, very limited economic sensitivity, often inflation-linked, right through to the more cyclically orientated parts of the real asset universe, such as shipping, or even parts of the commodity market. So very, very attractive. It's clearly an attractive area of the market to be looking at, and you know, it's something that we are very positive on with regards to our allocation within alternatives. So if we go on a little bit, what I've put together here is just some sort of outlook slides, and then one example to highlight an infrastructure opportunity, a property opportunity, and a renewable opportunity. And just dealing with infrastructure initially, what we show here on the chart is a really fascinating sort of picture of how the US infrastructure spend as a percentage of GDP has declined over time. I mean, this is going back to 1950, and the sort of Waverton green line shows this percentage of infrastructure spend as GDP is really at all-time lows. And as we come out of and recover from COVID, and there are actually big fiscal budgets being prepared and actually being passed, we think it's very, very likely that this changes, and that infrastructure in its all manner, be it renewables or be it other parts of traditional infrastructure, has a very, very attractive runway for growth. And why is that? Well, that's the dark grey line here, which shows that the age of many infrastructure assets within the US, they've never been older. So there's a real requirement here to build and construct certain assets to replace old and antiquated assets in the US. And also there's a clear change in policy here, where governments are looking to spend more to engender growth. So I think, you know, the broader thematic for infrastructure is very, very attractive. And if we just fast forward to one of the specific opportunities that we have, we own within the real asset funds, this is Cordiant Digital Infrastructure. This is one subset of the infrastructure opportunity set, which is actually growing the strongest, right? If you think about how essential communication and data has become to our everyday life, here we are on a Zoom call discussing investment opportunities. How does that work? Well, that works through the type of essential infrastructure, be it the towers supporting the transmission of the data, be it fiber also transmitting the data, or the data centers housing it. And Cordiant are a business that have come together through a number of industry experts to capitalize on this opportunity. They IPO'd nearly 2 years ago. They've got some assets in Europe and the US, and really are providing absolutely essential infrastructure to enable ongoing communication businesses to operate. And what we show there in the graph stroke picture is some of the cables that connect countries around the world and transport the ever increasing amount of data. And I think this particular spot has a really, really attractive runway to growth, as it's quite clear that we are requiring ever increasing amounts of communication via mobile, the data that goes with that, the businesses moving into the cloud, etc. And there's an attractive return stream for investors to be earned here. A circa 3% yield, total return of 9 to 10% per annum. If you compare that to what you might earn in the fixed income market, you can see the attractive nature of it with very, very limited economic sensitivity. So that's an infrastructure holding. If we go on to the next example, we're just going to touch on one particular area of the real estate universe. What this chart shows here is actually a very, very tight and increasingly tight supply-demand picture for logistics warehouses in the UK. So what you've got here is the availability of purpose-built logistics in the UK and the take-up by commercial tenants. As we all know, within the various retail channels and indeed business to business, businesses are having to move online to survive. The pandemic accelerated that transition, and although we've seen some very, very strong performance from some of the property names in the recovery post the pandemic, actually at a fundamental picture, there is a very, very tight supply demand picture in particular areas of the real estate market. And I would highlight here the logistics space, which is both Amazon warehouses for delivery, but also, as I'll come on to talk about the example, actually a little bit closer to home with regards supermarkets. So if you just flick on, we've got the example of the Supermarket Income REIT. This has been a holding in the Waverton Real Assets Fund since launch back in November 2018. And you say, Luke, well, why the hell would we want to own supermarkets? Well, if I just flip that to say, well, these aren't just your co-op on the corner. These are mini grocery logistic hubs for the likes of Tesco. Now, as you may or may not have found out over the pandemic, it was almost impossible to get an Ocado delivery. They were completely swamped. And their model is to have one enormous warehouse and service as many individual customers as they can from that. That proved to be actually pretty ineffective. And what Supermarket Income REIT do is they identify the absolutely mission critical supermarkets for the likes of Tesco around the country. And you may notice that many supermarkets have moved from just a physical store where you go and do your groceries to actually mini distribution hubs. At the back, they'll have the distribution, where they're doing the delivery, and there'll also be click and collect. And these supermarkets, Supermarket Income REIT owns them, and Tesco or Sainsbury's, etc., pay Supermarket Income REIT and us as investors a very, very attractive long-term index-linked lease. And if the chart there on the bottom right shows you the attractive level of yield that you are picking up from an investment in Supermarket Income REIT versus other inflationary linked assets such as UK index linked. So the yield available on Supermarket Income REIT is just under 5% currently. If you compare that to where UK index linked bonds trade at a negative nearly 3%, there's an 8% pickup in index linked income return available from a company such as this. And I'm happy to go into a bit more detail, but in the interest of time, this is a really, really attractive space to be in. Index-linked income, limited economic sensitivity, pick up over traditional inflation-linked assets, and some pick up in long-term returns. I've got one more example for you. This is the obviously massively growing area of renewables, and I came across this sort of graphic and chart from one of the companies that we invest with Brookfield, which just show over the course of the last, from January 2020 through to November 21, the sea change in financial commitments and pledges to meet net zero. So countries pledging to meet net zero went from 21 to 140. Emissions covered by countries' net zero commitments, 30% to 90%. And I think the absolutely fundamental takeaway here is this level of financial commitment to meet net zero, which went from 5 trillion in January 2020 through to 130 trillion currently. And what's fascinating about this is due to the unfortunate events that are underway currently with regards supply, demand, energy, Russia, Ukraine coming off stream, etc. It's likely that this transition is going to be accelerated. And within that, there are some fantastic opportunities for us to exploit and invest in. And one of those is on the following page, which is Brookfield Renewable. This is actually, the other two are London-listed investment companies. This is a US, dual-listed US and Canada-listed business. Brookfield are a market leader in real estate, infrastructure, renewables, and this listed business allows us access to the full Brookfield pipeline of renewable developments globally. It's got a bit more of a North American bias, but really they are one of the few businesses who can actually go in at a sovereign level and help some of these countries meet these very ambitious net zero targets. This company has delivered and targets a 12 to 15% total shareholder return. They are very confident of being able to do that on an ongoing basis. And it's really a company which allows us access to what in our mind is one of the leaders in being able to develop and own and operate renewable assets globally, which is clearly a growth area and some very, very attractive returns to harness. I think I'm going to wrap up with just how our real assets fund is allocated currently. And there are a couple of takeaways I want to leave you with here that, this specific fund, we want to be diversified at those real asset class levels. This is not just a property or infrastructure play. It's got property, infra, asset finance, commodities, and specialist lending. But even within each of those areas, there are some individual return drivers. So the property is not invested in broad commercial property. We want to be very specific and targeted about how we invest there. So you'll notice we've got healthcare, be that GP surgeries through PHP or care homes through Target Healthcare. We've got industrials, be it Tritax in the logistics space. We've got social housing, etc. So we tend to be invested in specific companies which have a very, very good structural demand picture to them. And within infrastructure, we've got renewables, we've got digital, we've got energy efficiency. It's often not just switching to renewables, but it's also about using our existing energy more efficiently. So, we've got some great underlying companies here which are generating some attractive returns and also often providing a slightly wider benefit to society. The other thing I would just highlight here is the commodity exposure, which we've increased over the last 12 months. We were back at the end of 2020, we were probably about, we were 1% in commodities, and over the course of, by the end of last year, we were up to 8%. And we think many commodity markets, be it oil, be it specific metals, have a very, very tight supply demand picture, coupled with the fact many investors are significantly underweight the opportunity set. So there's some good value in many of the listed businesses, be it in copper mining, albeit in traditional integrated oil and gas. So it's an area that has been a good positive driver of returns year to date, and we are mindful that that could well continue. So I think that's the last slide I have. I'll just sort of wrap up and say that, at an aggregate level, we have approximately 75% of the real asset funds has high or medium link to inflation, and that is a really attractive feature in this current environment where the outlook for inflation and interest rates is very uncertain. But we do feel reassured that even in a moderate or higher inflationary regime, we are receiving an uptick in both our income and hence potentially the capital value as those cash flows are increased each time or each year due to the higher inflationary number.
Great, thanks very much for that, Luke. That was really insightful and some really interesting bits in there, not only from myself, but I guess from the people that have signed up for this. We've got a couple of questions that have come in that we'd like you to just answer with your expertise. So one of those questions come in: is your current outlook not that we're going into a recession rather than still being in recovery from COVID? Hence, warehousing likely to suffer as businesses do. So I guess on a more macro scale, your outlook is that we're going into recovery mode rather than entering what could be a recessive period. How would you assess that?
I would say we're probably beyond the recovery from COVID stage. I think we are not of the view that a recession is nailed on by any means, but there is certainly it is highly likely that growth will be weaker than consensus was expecting at the beginning of the year. And you combine that with inflation was high at the beginning of this year and is probably likely to continue to be higher because of the unfortunate events out in Russia and Ukraine and the pressure that puts on commodity prices. So, I think it's an extremely uncertain outlook, but at this juncture, we think growth is low, inflation is high, but not runaway. And, that is an environment that certain businesses, certain real assets even, can actually perform okay in. So if you take our overall asset allocation stance as a house, we are neutral equities. So we are not of the view that one wants to be, significantly underweight here. And we actually think the real pain, or not pain, but the area that looks significantly challenged on a long-term basis is parts of the fixed income market. So, I would say we're slightly more constructive on the equity outlook, the real asset outlook, than we are on fixed income, and that's reflected in our asset allocation.
Great, thank you. And then another question here: perception that holding more real assets can tend to make a portfolio more illiquid. In times of stress, the likes of property funds have tended to come a bit unstuck, as we've all seen with the unitized fund. How does Waverton assess and avoid illiquidity within their portfolios?
Yeah, no, that's a very, very good question. Now, many of these underlying real assets are quite illiquid in nature, right? So if you think about, property, etc., is illiquid, or renewable asset is illiquid. We will only invest in, this is a daily dealing UCITS fund, so we will only invest in listed and eligible securities which are UCITS eligible. Now, the quid pro quo of having daily access into this opportunity set is that at times of stress, you cannot avoid some element of equity market correlation. And we saw that over Q1 2020. We were also invested in real assets, not via this fund, but in the wider business over the GFC. And that is an unavoidable reality of having listed access to underlying attractive real assets. But the positive factor that came through over 2020 was, yes, we had a drawdown over Q1, but many of the businesses, as soon as they began to report, the NAVs were stable, income profile was maintained. And actually, over the long term, what you will get access to here is the underlying return streams delivered by the business. But what one has to be mindful of is in the short term, you can pick up equity market correlation. Now, the second point was about liquidity, and clearly, there is limited or less liquidity in certain investment company names than others. It should be clear here, we've left the universe very broad, so we can invest in investment companies, listed direct stocks, harnessing the wider Waverton team. We can own open-ended funds, we can own ETFs, etc. So we've left our universe broad in terms of the best way to invest in real assets. But I would think you should think about the overall liquidity of this fund as somewhere halfway between, global large cap listed equity and, very illiquid high yield bonds. And when we launched this fund back just over 3 and a bit years ago, we were tasked with the fund manager saying, can you stay true to the real asset principles and invest in this asset class via daily dealing UCITS? And we felt we could, and we also felt that the universe would grow materially. And that has definitely transpired. If you take Supermarket Income REIT, that was a business that was just over, we just managed to launch in 2017 with 100 million equity market cap. It's now well over $1 billion market cap. And there are a number of businesses which have done the same thing. So the universe here has grown materially. We would not like to, say that, it is the most liquid, but the whole fund is monitored on an independent basis by our performance and risk. And we believe, we are well within, the parameters of running a daily dealing fund. And as you can see, it's sufficiently diversified and not concentrated in one particular area or name.
Perfect. Great. We've got quite a few questions coming in actually, so I'll just rattle through a couple of these. How high do you think yields can go globally before something breaks?
Yeah, I wish CIO was here and I could pass that question on to him. But it's two distinct things I think you want to change there. How high do we think base rates can go before something breaks, or how high do we think yield curves and 10-year yields can rise before something breaks? As I'm sure you're no doubt aware, what we're seeing at the moment is actually expectations of base rates are creeping up, but the 10-year is staying the same. So what we've got going on at the moment is a flattening of the yield curve, i.e. investors don't expect long-term rates to move much higher, or they're expecting the base rates to cause a slowdown in growth and potential recession. So personally, I don't think interest base rates can rise materially, and debate what materially means. The US Fed have got 7, I think, further interest rates baked into market expectations for the remainder of this year. I think I would be very surprised, given the growth outlook, they were able to do as many as that. So I personally think there's a bit of a cap on 10-year yields and interest rates from a slower growth outlook. And I think I'd be very surprised. We've got a proper cost of living squeeze coming on. All the non-discretionary items are going up. Fuel, rent, food. That's going on in the US, that's going on in Europe, that's going on in the UK. I would be very surprised if into that environment, central banks materially moved interest rates higher. So I think we're in a lower for longer environment, but unfortunately with a slightly higher rate of inflation.
Perfect. Okay, we'll take one more given the time we've got. What are the charges for the Waverton models, and what is the total OCF of the portfolios themselves? Is this the same across?
Yeah, John might. Sorry.
Yeah, I'll take that. But if you could just flick one slide on as well, so people could see put it in the context of the performance, I guess, as well. The charges for the portfolios, as I showed you earlier, we build the portfolios through these 4 asset class funds. Those funds charge out on the platforms at 40 basis points each. But if you look at an OCF for our models, that includes everything. What we charge includes any underlying costs and includes transaction fees. So everything altogether, the models are between 75 and 85 basis points. So the growth model will be actually about 72, I think, at the moment. And the defensive models are slightly higher because they have a bigger allocation to alternatives at the moment, which is instead of the fixed income. So I think that's fair and reasonable, particularly given the performance that you can see in front of you there. 2020 has got some dots around it because we consider that to be a kind of proof of concept period for us. Our concept being participate when markets are doing well, protect better when they're falling. So in the you can see the growth model 16, 17, 18, 19. We tended to beat ARC, but only just. There would have been others that were knocking the ball out of the park at the top. In 2020, certainly in the early part, we protected much better than everyone else, which led to a much better year. And then the results, from the reinvesting cash from some of the protections rallied on through 2021. So we got a significant outperformance in that year as well. So These are all net of fees, and so the question, the fees are between sort of 72 and 85, depending which strategy you're in. That's all in, everything included, which I think is pretty competitive. You'll struggle to find a properly active solution that doesn't include a load of passives coming in much better value than that.
Perfect. Great. Well, thanks for that, both. And I guess that just leaves me to wrap up and once again just say thank you to the guys from Waverton for their really useful insight and expertise. It's great to hear DFM's perspective on how they use different asset classes and alternatives to diversify and add value to the investments. As I say, there will be a recording of the webinar available that we'll post on our website, and we can also make available to you if you missed any bits on request, so that you can then revisit any of the points within. Details of our next webinar in the series will be landing shortly in your mailboxes, so please do keep your eyes peeled for these. And I guess that just leaves me to say thanks once again to Luke and John, and thanks for your attendance today. We look forward to engaging and seeing with you all very soon. So take care and goodbye.
Thank you.
Thanks very much.